Hi guys. So I decided to do my Opportunity 2 presentation on FASB Codification 805-50-30 and to show how it applies to intercompany sales of equipment. So first, I'd like to lead with a historical event. In 2013, U.S. Airways purchased American Airlines for $11 billion. This action brought two of the five largest airlines in the United States under the control of one entity, U.S. Airways. One result of the sale was that intercompany sales of equipment from American Airlines to U.S. Airways occurred. And because this was from the subsidiary to the parent, this was an upstream sale. And we will be looking at an example of this later on. So now let's introduce a problem to intercompany sales of equipment. Under the economic entity concept, intercompany sales of equipment should not be accounted for in the consolidated financial statements the same as if the equipment was sold to an outside company. The solution to this is that gains or losses on the sale of equipment should be eliminated before the consolidated financial statements are published. In addition, any changes to depreciation need to be recognized before the financial statements are published. Here is FASB topic 805-50-30. Assets are recognized based on their cost to the acquiring entity, which generally includes the transaction costs of the asset acquisition, and no gain or loss is recognized unless the fair value of non-cash assets given as consideration differs from the asset's carrying amounts on the acquiring entity's books. This will be superseded in December 2017 by the FASB Standard Update 2017-05 to include non-financial assets as well. So, let's dig into this deeper. With an equipment sale to an outside entity, the asset should be recognized based on cost, and a gain or loss should be recognized if the fair value of the non-cash asset, equipment in what we're looking at, is different from the book value. But in an intercompany sale, any gain or loss on the sale of equipment between parent and subsidiary and changes in depreciation must be accounted for, then eliminated. So let's turn to an example with journal entries. So before we go ahead and get started on the problem, I just wanted to show you guys the video that I got the problem from. I found the video on YouTube. It's by Accounting Ed, and it's one of the few upstream intercompany sale of equipment problems that has a full Excel walkthrough. So we'll go ahead and do that walkthrough now. Alright, so let's get started with this problem. We'll start here on the Scenario tab and read the scenario for the problem. On May 1st, year 8, subcompany sold to parent corporation, its parent company, for $120,000, machinery with a carrying amount of $90,000, net of $10,000 accumulated depreciation, a remaining economic life of 6 years, and no residual value. Parent adopted the straight-line method of depreciation for the machinery. Parent owns 80% of sub's outstanding common stock. Okay, so now that we know the scenario, let's go ahead and take a look at some journal entries that will accompany this problem. First, on the parent's books, on the date of sale, equipment will be debited for $120,000 and cash will be credited for $120,000 to record the intercompany purchase of equipment. On the subsidiary's books on the date of sale, cash will be debited for $120,000, equipment will be credited for its book value of $90,000, and a gain on the sale of equipment will be recorded for $30,000. At year end on the parent's books, depreciation will be recognized on the equipment. So depreciation expense of $20,000, which is $120,000 divided by 6 years, and accumulated depreciation of $20,000 will be recognized for the year. So before we get into the eliminating entries, Let's look at the Depreciation Recap tab to get a better idea of how we're treating depreciation in this problem. Okay, so now here on the Depreciation Recap tab, we can see what's going on with changes in depreciation. Here we can see that the parent's cost was $120,000, while it was being carried on the subsidiary's books for $90,000. Now, had this been a full year, the parent would be depreciating the equipment by $20,000, which would be $120,000 divided by 6 years of its life. The subsidiary would have been depreciating the equipment for $15,000. However, because the purchase was made on May 1st, we have to account for depreciation for 8 of the 12 months of the year. So instead of $20,000, the parent will be depreciating $13,333. And the original, the subsidiary, would have been depreciating $10,000. However, this still leads to an overstatement of depreciation of $3,333 for the year. So let's go ahead and take a look at our eliminating entries and how depreciation and the gain on sale are treated. Here in the eliminating entries section, let's look first at this entry for accumulated depreciation and depreciation expense. So remember from the Depreciation Recap tab that depreciation was overstated by $3,333. So here on the Journal Entries tab, to eliminate the overstated depreciation, we have to debit accumulated depreciation for $3,333, thus reducing it, and credit depreciation expense for $3,333, thus also reducing depreciation expense. And this eliminates the overstated depreciation resulting from the intercompany sale of equipment. So the second eliminating entry is where things get more interesting. You'll notice that equipment is credited for $30,000. This is to bring the value on the parent's books back down to the value on the subsidiary's books, which would have been $90,000. And you'll also notice that net income is debited for $24,000, and non-controlling interest is debited for $6,000. This is because this was an upstream sale of equipment. If the subsidiary had sold the equipment to an outside party, the parent company would have received $24,000 of the gain on sale, and the non-controlling interest would have received $6,000 of the gain on sale. Thus, because the parent company owns only 80% of the outstanding common stock, $24,000 of the net income, the gain on sale of equipment that arose from the sale of equipment, must be eliminated from the net income of the consolidated corporation, while $6,000, 20% of the $30,000 gain, must be eliminated from the non-controlling interest. And this eliminating entry eliminates the gain on sale resulting from the intercompany sale of equipment. So there you have it, a solution to the problems that arise from intercompany sales of equipment. I hope you learned something today and that this was helpful. Thank you guys.